Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video we're going to be talking about BFT and Paysafe stock again, and again in this video we're going to be talking about the lockup period, but specifically when and why we know that both Blackstone and CVC will be selling their stakes. Now as part of this we will be looking at some important data points, and as well as that we do have some analysis underpinning it, as with everything we talk about on this channel, and you won't have seen this point discussed on YouTube yet, and I can guarantee you that. Now this video is not my opinion, it's legal, it's in the documentation of these private equity funds. As part of this analysis, we will also be looking at the returns that the funds will make at various stock price levels. And we will also discuss why it's not good for private equity funds to be holding stakes in listed companies. If the detail doesn't interest you and you're not fussed about the analysis, then here it is. Ultimately, the funds generate an adequate return by selling their entire stake at a $10 share price. A $12 stock price would be ideal for the funds, and at that point would generate them a very good return. Coincidentally, the same price, which if you've seen the other videos on the lockup period we've done on this channel, you'll know is the price at which point, if the stock trades above that for a period of 20 days, the lockup period is shortened, and then any stock price above $16 would be an absolute home run for the funds. CVC need to have exited their stake in Paysafe by 2023, and the same goes for Blackstone by 2025. However, we'll go into all the detail, all the analysis in this video, so you definitely don't want to miss this. If you're new to the channel and you like investing related content, then please hit that subscribe button. Now that I'm back to work after the holiday period, my posting schedule will become a bit less predictable. The YouTube algorithm doesn't seem to like this, so unfortunately it seems that a lot of people are not seeing my videos. To make sure you don't miss them, if you hit that bell next to the subscribe button, you'll be notified and they'll definitely be in your homepage. In making the videos on this channel, I always put in a lot of research. There's always analysis that accompanies that, and it all takes a lot of time. If you appreciate that, please smash the like button. It's so helpful in pushing the channel to a wider audience. And as always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. So to explain this clearly, I do need to go into some of the details of how the private equity model works. I will keep it as simple and as high level as possible, so please bear with me. Ultimately, knowing the key factors which drive the timelines for both Blackstone and CVC is so important, and it comes ultimately down to how private equity funds are structured. In this, there are some similarities to how SPACs are structured, so we'll compare and contrast those. So the private equity companies, which you'll recognise the names of, Blackstone and CVC being those for example, have a model where they raise funds. Now these are closed funds, where money is raised from investors with a specific strategy in mind, with the goal of investing in between 8 to 12 companies within that fund. The very established names within private equity, Blackstone and CVC for example, have raised many funds. However, the important thing here is that they're closed funds. What that means is that once money has been raised from the investors, the fund is opened, the investing period starts, and new investors can't join that fund and existing investors can't leave. That's a closed fund. Now an important point here is that investors into the private equity funds themselves are called limited partners or LPs. Now this is important to keep in mind, not only for later in this video, but also when thinking about how the private equity funds may be able to sell their stakes in these companies. Now the important thing to keep in mind about a closed fund as well is that it's inherently illiquid. The companies which the fund is investing into are private companies, and unlike stocks on the stock market, can't be sold at any point in time. When there's an opportunity for a private equity fund to have a liquidity event, as is the case here with BFT, having that liquidity opportunity is massive, and the funds will capitalise on it. Now another important point within the structuring of private equity funds is actually the timeline they have. Now, not dissimilar from a SPAC, in the way a SPAC has a 2-year lifetime from its point of IPO to trying to find and complete a transaction, a private equity fund has a lifetime as well, a lifetime of 10 years. It has 10 years to invest that fund in 8 to 12 opportunities, have grown those sufficiently and sold them. Now in the same way that a SPAC can be extended by shareholder vote, a private equity fund can theoretically extend as well. It requires a vote being passed amongst its limited partners. However, within private equity, this is typically avoided at all costs. Not only is it not good to show that you haven't had the ability to drive liquidity within your portfolio, it may mean there's less appetite for the future funds you raise, and ultimately it demonstrates that you're not able to return the capital to your LPs within the prescribed period of time. So funds really will try and avoid this wherever possible. Now the other important points to note about the private equity model is that typically funds like to be invested in companies from between 3 to 5 years and target returns of 2 to 2.5x, that being 2 to 2.5 times the amount of money they invested into the company. Over time, as the asset class has become more commoditized and competitive, return expectations have decreased somewhat. So for a large fund like Blackstone or CVC, 2x across its portfolio is a good return. Now the next point to touch on is how the company which manages the fund, for example Blackstone managing its 7th buyout fund, Blackstone 7, makes money. they charge their investors a percentage on the money which is committed. Typically this percent is in the range of 1.25% to 2%. So for the simplicity of the maths, assuming a 2% management fee on a 10 billion fund, that equates to a fee of around $200 million per year. Then on top of this, the fund also takes its own share of the profits which have been generated from the investments. Now this stands true as long as a hurdle rate has been met. Typically this is around 7% compound annual growth. So as long as a return of greater than that is generated, the fund itself takes around 20% of this. So using the same example as before, from a $10 billion fund, assuming the fund generates 2x on its investments, that ultimately means that the fund has generated $10 billion, i.e. $10 billion of profit for its investors. The fund itself will take 20% of that. So in this example, $2 billion. This component itself is called carried interest, or you may see it also called carry, and forms a key component of the remuneration and the pay of private equity investors. It's usually shared amongst the entire firm to ensure that the entire firm has similarly aligned incentives. So ultimately, what we know from this is that 10 years from the point in time which each of the funds were raised is the very last point in time which both CVC and Blackstone want to be selling their stakes. Everyone within the firm has the same motivations to sell, and what's more, private equity firms are not structured to be holding stakes in listed companies. So the next important question, which fund did Blackstone and CVC make their investment into Paysafe from, so we can get an idea of the timeline? Well, what I'm going into now isn't necessarily available in the public domain. I've gathered this information from a number of friends and contacts within the industry. I've validated that using a couple of sources which are behind a paywall. I will on screen show as much as I can. However, if you do some Googling, you will also be able to come to the same conclusions. So firstly, Blackstone. So Blackstone made the investment into Paysafe using its Blackstone 7 fund. This is an $18 billion fund raised in 2015. Now that 2015 is the important part. We know that the 10-year lifespan, they have to have exited this investment unless they want to go to their investors, explain why they need more time, which in the case of a listed company like this will definitely raise eyebrows. Ultimately, we know from this they're definitely going to be thinking about exiting their investment. Now, whilst this may sound like it's a while off, you do need to think about the bigger picture of the transaction. Assuming this transaction does hit its timeline, it becomes effective in Q1, Blackstone will be locked up and unable to sell any more of their stake until Q3. Knowing where we are in the current economic cycle and the ever ongoing potential for a market correction, it's very likely that given this liquidity opportunity, Blackstone will capitalise on that. However, if they did decide they wanted to hold their stake in the company, the maximum time they could do that until is 2025. Now, that's a slightly different case for CVC. CVC invested into Paysafe from their CVC Capital Partners 6 fund. This is a €10 billion fund raised in 2013. What that means, knowing the 10-year horizon, they have until 2023 to have exited their investment. Now, taking a step back, it's important to look at the other companies which are held within these portfolios for both private equity funds. The ongoing health crisis has had a massive impact on those, and certain investments within the fund are definitely challenged. There's been less opportunities for liquidity in businesses which have not performed particularly well, and ultimately returning capital as quickly as possible to investors from these funds is going to be paramount for both Blackstone and CVC. Now, before we go into the analysis and understand the various prices which the funds could sell at to generate a sufficient return, I'm going to touch on quickly why it's not good for private equity funds to be holding stakes in public companies for too long. Now, firstly, the way private equity funds work is that ultimately, because there's no transparency on the valuation, there's not an open market where shares can be traded, the valuation exercise, which occurs internally for the sake of its LPs on either a quarterly or half-year basis, is more of an art than it is a science. Ultimately, companies are valued on the basis of their EBITDA. An EBITDA multiple is then applied to that on the basis of what recent companies in the same sector have transacted for, what the listed companies in the sector are trading for, and that gives you your valuation. When private equity funds hold a stake in a public company, every day the price is changing. What's more, there's a lot greater scrutiny on all the decisions which are made by the company, and there's a lot greater transparency for investors. This is not something private equity firms want. In addition to this, investors which hold stakes over a certain percentage in listed companies have a greater regulatory requirement. Again, funds aren't set up for this. It's an increased regulatory burden and it becomes a headache. A KPI for both of these funds in their investor reports is the decrease in the percentage of the portfolio which is currently in listed stocks, this being companies which the fund has exited through IPOs, through SPACs, and where the lockup period has not yet expired, or they still hold the stake in that company for whatever reason, perhaps say the valuation. So let's now go into the analysis and let's look at the price which the funds may need to sell at in order to generate an adequate return. Now ultimately we know that they're targeting a 2x return, a 2.5x return is good, and a 3x return is great. Now in this analysis, and admittedly it's very high level, however indicatively and directionally it is correct. We know how much the funds have invested into the company originally because when they bought Paysafe it was a take private, i.e. Paysafe was listed on the stock market, they acquired the shares and made it a private company, and this figure I've translated into USD at the time of transaction. Now we know from the investor presentation how much money at this point in time both Blackstone and CVC are making, and on the basis of these rough calculations, the return is less than 1x. Said differently, they've not returned the full amount that they have invested to the investors on the basis of the stake they've sold so far. So now, looking at the various share prices and the potential, at what price may they sell to generate an adequate return? So on the basis of this analysis, we can see that at a share price of $10, they make a respectable return, and they'd be willing to sell at this price. At a stock price of $12, which as discussed in the previous lockup video, is the price which the lockup period would be shortened for if it trades above this price for a period of 20 days, they'd generate a good return. And if at current levels and above, say $16, the return would be considered amazing, an absolute home run for the fund. Now, if you've seen the price analysis videos on this channel, you will know that actually, on the basis of that analysis, I do believe the company is fundamentally undervalued. And so taking the low end of that range, say $25, the return that would generate Blackstone and CVC would mean that it would be up there with one of the best investments they've made. Now, on the basis of this analysis, on the lack of certainty over the future for the public equity markets, and the increasing concern about the economic climate and conditions, I do believe ultimately Blackstone and CVC will both seek to sell their investment fairly quickly. We do know the date by which they have to, however I do believe on the basis of this analysis and the opportunity to generate liquidity at these levels, which by no means is guaranteed into the future, I do think that it would be stupid of them to not capitalise on that. So what does this mean for us as investors? Well, again, not much. Well, either you're a long-term investor, and so you have to accept and be aware of this period of time where there will be turbulence in the price, or alternatively, you look to sell your investment before the expiration of the lockup. It's not a massive concern, just as an investor, it is really important to understand. But look, thank you so much for watching. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel and you like investing related content, then hit that subscribe button. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the debates, opinions, discussions, so please get involved. Thank you so much for watching, and I'll see you in another video.